Okay, part three, exhaustive. Oh, exhaustive guide to buying a house with a mortgage. Part three, some terms you need to know as a first-time home buyer, or acronyms you'll stumble across. Here they are. Ability to repay. The ability to repay is a rule. Um, is the reasonable good faith determination most mortgage lenders are required to make that you're able to pay back the loan. Under the rule, lenders must generally find out, consider, and document a borrower's income, assets, employment, credit history, and monthly expenses. So let's talk about this. Um, General lenders must generally find out. So I'm going to ask you how much money you make. I'm going to ask you how much money you have in the bank. I'm going to ask you where you work. I'm going to ask you how long you've worked there. And then we're going to ask you for pay stubs. And we're going to ask you for pay stubs to confirm that you make what you say you make. Typically, on a pay stub, it's going to have a year to date. And one of the things that complicates this whole process is if you've only been working there for 3 months and you change jobs. Typically need a 2-year job history. And it's nice when that 2-year job history is with the same job. That doesn't mean it's absolutely necessary, but it's nice. It makes it easier. But when you have had a job change during the same year, we're going to need your prior employer's information. Um, we're going to need your prior employer's information all the way back for the last 2 years. There are ways that there's circumstances when we can uh, pull mortgages off without a two consistent same jobs, but we're going to need some details. Um, we're going to consider and document. So we're going to ask you for pay stubs. But then after we ask you for pay stubs and we get you pre-approved, then we're going to send out a verification of employment, and we're going to get your employer to send a statement back verifying that you actually work there and verifying how much money you make. And we're going to send out that verification of employment probably right after you get under contract to buy a house. And then a couple of days before closing, or the day of, or the day before closing, we're going to do a verbal verification of employment. We're going to call your employer and say, hey, does Jane Doe still work there? And if for some reason your job has changed during that, or you got fired, or you lost your job, or they answer and say, yeah, for the moment, but we're thinking about firing her tomorrow, that kind of thing could stop your mortgage. So, be careful, work hard, do a good job, make sure you still have an ability to repay when this loan comes time to close. Your credit will also be checked again. There'll be a soft credit pull the day of or day before you're closing. If anything changes in your monthly credit expenses, that could be a problem. So make sure that you have an ability to repay this mortgage all the way up until closing. And then, of course, after closing, you should still have an ability to repay, because if you don't, you could get yourself into some trouble and not be able to repay your mortgage. Let's talk about debt to income ratio. Let's see. Did I say anything over here on these previous slides I need to discuss? We need to check here. Let's see. Um, yeah. Unfortunately, knowing that dad always bails you out if you get in trouble is not considered an ability to repay. So be careful of that. Okay. Um, debt to income. Your debt to income ratio is all your monthly debt payments divided by your gross income, gross monthly income. Um, USDA max is 41%. They're really going to want 39%, and um, that's the back end debt to income ratio is that 41. It's really going to typically want to be 39. In other words, your car payment, your house payment, your credit cards, all of those payments are less than 41%, or typically 39%. Less than 39% of your monthly gross income. So let's say you make, for just for round numbers, let's say that you make $1,000 a month. Your mortgage payment needs to be under $290, and your total credit payments needs to be under $390. So if you just look at those numbers, 290 and 390, so it's almost 300 and almost 400. So it's $100 of the 400 can be other things. So just be aware, if you go out and you say, yeah, they say I can afford this $500 a month truck payment. Well, just be aware that if that's your only other debt than a mortgage, $500 truck payment needs to mean you're making $4,000 or $5,000 a month for it to fit into the ratios. I'm on my soapbox again. Don't get a vehicle with a mortgage with a I said don't get a car with a mortgage payment, but that's what it is sometimes. I have these guys calling me all the time saying, I need to buy a house, and I say, well, let me look at your debt, and they've got a $590 truck payment and they want to buy a house for $400 a month. It's not a good fit. That's not going to be a match. Um, these are the upper end numbers, okay? We really need, and this is for your house payment and your car payment and all of your credit card payments. So these are bigger numbers, and so we got to be careful of the debt to income ratio. We really want to look to buy a house and where your mortgage is down in the under 30% of your monthly bring home pay. Um, let's talk about, oh, look at that. Some people say experts say closer to 25%. All right, let's move on. Loan to value versus total loan to value versus high total loan to value. A loan to value ratio is calculated by dividing the amount borrowed by the appraised value. In other words, if the house is worth $100,000 and you're borrowing $80,000, then your loan to value would be 80%. Now, total loan to value is if you have first and a second, or an equity line or a second mortgage. And so you have a first mortgage of $80,000 and a second mortgage of $20,000, then your total loan to value is $100,000. The high total loan to value, this would be the total line of credit of your HELOC computed with the first to give you a potential loan to value if you use all your credit line. In other words, if you've got a first mortgage of $80,000, you've got a home equity line of credit that goes up to $20,000, but you only have $10,000 on it, your total loan to value is at 90%. But once you consider the high total loan to value, it's 100%, because you could have used that home equity line of credit for another $10,000. Loan estimate. This is the most important thing when it comes to buying your property. This is the document that I'm going to send you once we have picked an address. You've got a property under contract. I'm going to send you a full loan estimate. On that loan estimate, you're going to be able to see your monthly payments, your estimated closing costs, your estimated homeowners insurance, your estimated taxes. All of that stuff is going to show what the total numbers. Wish it'd let me put it there in the middle, but it won't. PITI, that's principal, interest, taxes, and insurance. So you say, what is principal, interest, taxes, and insurance? Well, the principal amount of the payment is how much you're paying down the mortgage. So if your mortgage is $80,000 and your payments are $700, well, maybe at the beginning, a small portion of that is ticking down the mortgage amount. So every time you pay it, you owe a little bit less than that $80,000. The interest is the amount of interest that you're paying to the whoever is servicing or holding your mortgage loan. It's usually Freddie Mac, Fannie Mae. The taxes is what we're collecting in escrow. We're going to hold it for you. We're going to take a little bit of it every month, all year, and then when it comes time to pay your taxes, your property taxes in October, we're going to pay it. Make sure that your property taxes and your homeowner's insurance are escrowed. You want it that way. Now, some really smart people financially would say, no. I don't want to let the bank earn interest on my money. I'm going to put my money in the bank and I'll save up for my escrow, for my homeowner's insurance and my taxes. Well, in some cases you can do that. You're going to need to have pretty strong credit score. You're going to have a decent down payment amount, and you can do that. And if you're responsible enough and you're smart enough to know how to handle that, then that's an option. Just let us know up front that you want you want to hold your own taxes and insurance, I don't recommend it. It's not worth the hassle. In fact, I am a debt-free homeowner, so that means I have paid off my mortgage. I don't owe anything on my house. Um, but I really wish I had an escrow account because I'd like to pay my property taxes and insurance monthly instead of coming September and I get this property tax bill and I go, oh crap, there's a big chunk of money I got to come up with, and I may or may not have been saving appropriately. Let's talk about PMI. This is private mortgage insurance. It's required if you purchase a house and you put less than 20% down. In other words, if your loan to value is higher than 80%, you're going to have to pay mortgage insurance. I want you to have zero debt to income ratio someday. But my wife and I, on our first home, we paid private mortgage insurance for about 18 months. We actually paid FHA. I think our first loan was an FHA loan. We paid 3.5% down. I wish I'd have known at that time about a USDA loan because we probably could have done a USDA loan. It would have been uh, a lower mortgage insurance. It'd have been a lower funding fee. Everything would have been better. But I didn't even realize they existed at that point. But the PMI protects the lender. It's not you. If you stop making payments on your loan and they go to sell your property, and your property should, it should be worth $100,000, but they have to sell it fast. They only get $82,000. That mortgage insurance covers that $18,000 gap that you didn't pay. So why do you have to have mortgage insurance? Well, because if you didn't have any money to put down, then it's too big of a risk for a bank to take without giving you that mortgage insurance. You say, is there a way that I can avoid that? Yeah, you can pay up front. You can pay that insurance policy all up front. That's one way. VA loans actually allow you to finance that mortgage, that insurance payment all up front. So if you're a veteran and you qualify for a veteran's loan, that might be an option for you. But for the most part, if you're putting less than 20% down, you're going to pay some kind of insurance to cover that percentage that the bank could lose when they go to resell your house. FMV, that's not a very commonly used mortgage term, but it's fair market value. Fair market value is simply what the asset would sell for on the open market. CD, whoops, wonder if I didn't even define CD there. Let's see. Oh, yeah, it is. Closing disclosure. This is not a saving device. This is a CD. This is the document that you'll get. It kind of matches the loan estimate. It'll show you anything that has changed between the loan estimate and the closing disclosure. This is the last document that you get before you have your closing, before you buy your house. This will show you, and you should compare your closing disclosure to loan estimate. I get messaged a closing disclosure, get an email with a closing disclosure before it goes out to my borrowers. And the first thing I do is compare it to the loan estimate. I want to make sure that what I estimated this loan was going to cost you matches what it's actually costing you when you get the CD. Now, typically there's a few little changes because I didn't guess exactly right what your homeowner's insurance was going to cost, and I didn't guess exactly right how many days the previous owner was going to pay of the taxes and how much you're going to pay of the taxes. So it's going to change by a small percentage, but the CD should be pretty close to the loan estimate. And if I were you, I'd compare those two documents, and if there's any major discrepancies, you should ask your mortgage lender, ask them what's going on. We're at 14 minutes again, and the next thing I'm going to talk about is USDA versus FHA. So we're going to stop there and make a fourth part to this video.